Welcome to Talk Tickers. Do you ever see a company that just hits it out of the park on earnings, just crushes it, only to watch the stock tank? Well, that is the exact story with Sanmina. We're going to break down their latest quarter, which is a perfect example of what we call a beat and lower. So let's get into it and try to figure out this paradox.
So this is the big question, right? Sanmina delivered an earnings beat of almost 11%. That's a huge number. And yet, the stock immediately fell 8%. So what on earth is going on? What did Wall Street see that made them completely ignore that fantastic headline number?
And this really shows you the conflict perfectly. On one side, you have these stellar results. Revenue is soaring, earnings are way ahead of what anyone expected. And then on the other side, the market's reaction. Oof. It's a really clear sign that this story was never about the last 3 months. It was all about what's coming down the pike.
Okay, so to get to the bottom of this, here's how we're going to break it down. We'll start with the good stuff, the earnings snapshot. Then we'll unpack that paradox we've been talking about. After that, we'll dive into what management is saying, their big growth story. We'll give you some context and catalysts to watch for, and then, at the end, we'll give you our take for the next call.
All right, first up, let's just look at the numbers, because on paper, these results should have sent the stock flying. Sanmina really did kick off their fiscal year with an absolutely incredible performance.
The bottom line was, honestly, a showstopper. $2.38 per share. That's not just a beat, that's smashing the consensus estimate by almost 11%. This is the kind of number that usually has investors cheering, not, selling. And the top line? It told a very similar story. Just explosive growth. Revenue hit $3.19 billion, which is a nearly 59% jump from last year. Now, this massive increase was really fueled by their big acquisition of ZT Systems, which was a major strategic move to plant them right in the middle of the AI and cloud boom.
And this chart here, it shows you exactly what that strategy looks like in practice. A full 62% of their money is now coming from communications, cloud, and AI. So yeah, this isn't your grandfather's industrial manufacturer anymore. Sanmina has totally repositioned itself to be a key player in the big AI build-out.
And of course, management was thrilled. The CEO, Yuri Sola, he called it a great start to the fiscal year, and he stressed that they were executing their plan. So from inside the company, everything looked like it was going perfectly. The market, though, well, the market had other ideas.
So where did it all fall apart? Well, the answer is in one word: guidance. Because the market is always looking forward, and it really did not like what it saw for the next quarter.
This is it, right here. This is the whole story. Just look at the midpoint for the Q2 guidance. Revenue is guided to be basically flat. And maybe more importantly, earnings per share also guided to be pretty much flat compared to Q1. So after this amazing quarter of explosive growth, all the market could see was a brick wall. All that incredible momentum just looked like it was about to stall out.
So you can imagine the question for management, right? How do you respond to that skepticism? Well, their message was pretty clear. They basically said, hey, you're all focused on the next 90 days, but we're busy building a multi-year growth engine. They tried to shift the whole conversation to their much bigger long-term plan.
And that long-term vision, it's incredibly ambitious. They're telling investors the ZT integration is going just fine, AI hardware demand is still super strong, and hey, by the way, we're aiming to double the company's revenue in just 2 years. We're talking about targeting over $16 billion by 2027. That is the grand story they want you to buy into.
And this timeline really drives home that long-term point of view. Look at it. The ZT deal just closed a few months ago, and their new Houston energy factory, it won't even start production until 2027. So management is basically signaling, hey, this is a marathon, not a sprint. They're arguing that the real payoff is still years away.
Okay, so that really sets up the main conflict for investors. Do you trade on the short-term slowdown that the guidance is hinting at, or do you invest in this massive long-term transformation story? To make that decision, you have to know exactly what to look for going forward.
So here are the 4 big things to keep an eye on. Number 1, do they actually deliver on that cautious Q2 guidance? Number 2, how quickly are those new ZT customers ramping up their orders? 3, what's happening to their profit margins with this huge integration? And 4, are they hitting their construction milestones in Houston? The answers to these questions are what's going to tell us if that ambitious vision is for real.
So where does that leave us? What's the bottom line for investors? Here's our official take from Talk Tickers as we head toward the next earnings call.
So here are the 2 sides of the coin.
The bull case is that management is pulling off a brilliant pivot into an AI powerhouse, and this weak Q2 guidance is just a little speed bump. The bear case? That guidance is a huge red flag. It might signal that the ZT integration isn't going so well, or that demand is slowing down, and those long-term goals are just way too optimistic.
Okay, so weighing all of that, our rating on Sanmina is market perform. Look, the long-term potential of their pivot into AI is absolutely undeniable. But the short-term problems, that soft guidance, and the risks of integrating ZT are just too big to ignore right now.
And here's why, in a nutshell. That Q2 guidance clearly points to a slowdown. The ZT integration is a massive project, and there's a lot of risk involved in making it work. And yeah, the long-term AI story is really compelling, but it's still unproven for them at this huge scale. We think that at its current price, the stock pretty fairly reflects both that incredible potential and those significant risks.
And as we always say at the end of these explainers, this is not financial advice.